Welcome to Module 13 of Accounting 5000. In Module 13 we're going to cover the appendix to Chapter 6, which deals with the time value of money. This time value of money plays an important role in accounting, and we'll demonstrate to you in this module how we calculate the time value of money and how we can use it in actual situations. Let's talk first about the future value of money, and this is probably the most easily understood, because you know that if you take $100 to the bank, invest it in a savings account, that over time that money will earn interest and it will be worth more in the future than it is now. You can either use a present value or future value calculation on your calculator. You can use a formula that's in the spreadsheets of most computers, or you can use the tables that are in the books. For our purposes, we're going to use the tables in the books to make life easier for all of us right now, and we're going to calculate the present value and future value of money. The future value is simply the idea that you get interest on money you've invested, and additionally that the interest that you get over time pays interest itself. So you're doing what we call compounding your interest. You're going to get interest on your interest. The future value tables are in your textbook on top of page 207. It tells you how to calculate the future value of $1 if you invested at a certain interest rate for a certain number of periods of time. So if you'll notice at the top of page 207, they have the number of periods running down the column side. Those periods can be either years or quarters or semi-annual times. They can be all kinds of different types of periods. But across the top they have interest rates starting with 4, 6, 8, 10, and so on. If you read, let's say, at 4% for 10 periods, you will find a factor of 1.48. What that means is that if you invest $1 at 4% for 10 periods, or 10 years in our case, you would end up with $1.48 at the end of those 10 years. Also notice that if you invested, let's say, $1 for 20 years at 14%, you would have $13.743 at the end of that time. So what you're simply doing is taking the number of periods, the interest, finding the factor that intersects the periods and the interest rate, and multiplying that factor by the number of dollars you have. In this case, we've just used $1. So future value is fairly easy to understand. It's simply how money grows over time. Now the first table we were using there at the top of the page is only dealing with $1, what we call one payment, a single sum. So you'll hear me use that term for the next couple of minutes. Single sum means we only have one payment, one amount of money that we're dealing with. On the other hand, if you're dealing with equal payments of some amount over a period of time, we call that an annuity. For example, if you're making car payments of $250 a month for 3 years, that would be an annuity of $250. So the second table that you see there on page 207 is the future value of an annuity. For example, if you were investing $20 a pay period each month and you were going to do that for so many years at a certain percent, you could figure out how much you would have at the end of that period of time. I used something like this when my grandson was born. I decided to invest a certain amount of money in the bank account for, I was going to use 18 years so that when he got out of high school he would have some money to go to college. So I did my calculations based on 5% for 18 years using a set amount of money, and I calculated that he would have about $25,000 at the end of that period of time. Unfortunately, my calculations were based on the fact that I would get a 5% return on my investment. Well, as you know, right now you can't get 5% on an investment in a savings account. So I've had to add little money as we've gone along, but so far he's still on track that if we ever do get 5%, he will have $25,000 to go towards his college expenses when he reaches 18. So that's a practical application of how to use the future value of an annuity. So that deals with future value. We also have the term present value. Present value is telling you what a sum in the future is worth today. For example, if I know that I'm going to get $3,000 in 10 years, what is the actual value of that to me today? Well, obviously it's going to be less than $3,000 because the interest on that would be such that it would only be worth, say, $2,800 or something like that. Because if I had that $2,800 now, I could invest it, and at the end of 3 years, I would have the $3,000. So that's how present value works. Present value is working backwards. We know what we're going to have in the future. We want to know what it's worth today. Future value, on the other hand, knows what we have today, and it's working towards what we're going to have in the future. So if you can understand future and present values, then you've got a key term there. You also need to understand the difference between a single sum and an annuity, because there are 4 different tables that you're using here. An annuity is a series of equal payments. A single sum is just what it says. It's a one-time payment of a certain amount of dollars. So you have present value, future value, single sum, annuity. And those account for the 4 tables. Your present value tables are in your book on pages 210 and 211. They're a little more extensive than your future value tables, but they're basically the same. The number of periods runs down the first column. The interest rates run across the top. And table 6.4 on 210 is your present value of $1. And your table 6.5 on page 211 is the present value of an annuity of $1. So it's the same idea as we had with future value, only it's a little bit more complex in these 2 tables because there are more numbers. Present value answers the question, what is something in the future worth today? If we know what it's going to be in the future, what is it worth today? And again, it involves knowing the interest rate and knowing the period of time over which you're going to be calculating. Annuity is a series of payments. A single sum is one payment. Where do we use this then? Well, I showed you a practical example just a minute ago, saving money for my grandson's college education. But in accounting, there are a number of different uses for which we put this. For example, bonds, which we did an example of earlier, I gave you the number, but in real life you could have calculated that yourself. We use it for car payments if we know that we have to have a certain amount of money and we know how many months we're going to be making payments of that amount of money. We know what the value of that payment is. House payments are the same way. Perhaps one of the most fun ways to look at it is a lottery. You know that in the lottery they often tell you that you will receive $20 million paid out over 20 years. The question to you is, how much is that worth to me today? Yes, I'll receive $20 million over 20 years, or a payment of $1 million a year. But if I back that out, present value of an annuity, what is it actually worth? Depending on your interest rate, or what is often called a discount rate, you could figure out what it's worth today. So those are some of the practical applications we have for the time value of money. So let's just practice and see how it actually works in real life. Let's use about 3 exercises in the books to demonstrate that, starting with exercise 9. Exercise 9 is in your textbook on the middle of page 217. Exercise 9 says, using present value tables, so they've eliminated one problem for you. You know you're going to use the present value tables, or your calculator or a computer program if you have access to those 2 things. Calculate the present value of A car down payment of $3,000 that will be required in 2 years, assuming you pay an interest rate of 10%. Okay, so you know the amount is $3,000. You know it's a single sum. You know it's present value. So you know which table to go to. You're going to go to the present value of a single sum, which would be table 4. You know that it's going to be 10% for 2 years. So you'll read down the 10% column and across for the 2 periods, and you will find a factor of 0.8264. So if you take your $3,000 payment, multiply it by the present value of a single sum for 2 periods at 10%, you get 0.8264, and that gives you $2,479.20. That's what $3,000 at 10% is worth today, 2 periods away. In Part B, they say, a lottery prize of $6 million to be paid at the rate of $300,000 per year for 20 years, assuming an interest rate of 10%. This is just like we were talking about a second ago. So if we know the amount is $300,000 in equal payments, that's an annuity. For 20 years, that's the number of periods. 10% tells you the interest rate. So you would simply go to the present value of an annuity table, table 5, 20 periods, reading down the 10% column, you get a value of 8.5136. You multiply that by your $300,000 payment. So the present value of that payment of $300,000 for 20 years at 10% would be $2,554,080. In C, they ask you to assume the same thing as you did in B. In other words, you're going to get a lottery payment of $300,000 for 20 years, but the interest rate this time is 14%. You use the same table, the same number of periods, 20 periods, but you read across at the 14% interest rate column, and you get 6.6231. You multiply that 6.6231 times your $300,000, and the value of the present value of that annuity payment from the lottery is $1,986,930. In D, a capital lease obligation that calls for the payment of $8,000 a year for 10 years, assuming a discount rate or interest rate of 8%. Okay, if it's a payment of $8,000 per year, that's a series of equal payments, so that would be an annuity. You're wanting to know the present value of an annuity, so you go to table 5. You look across at the 8% column for 10 years, and you find a factor of 6.7101. You multiply that by your $8,000. So the total present value of that annuity is $53,681. So those are good practices on present value of single sums and annuities. Let's continue our practice with problem 10, which is right under there, and let's look at some of the differences in things that can occur. It says, using the present value table, your calculator or computer program, verify that the present value of $100,000 to be received in 5 years at 16% compounded annually is $47,600. Okay? You can do that by simply finding the things and calculating them out. Then it tells you to calculate the present value of $100,000 for each of the following items. The first one is interesting. Assume that the interest is compounded semi-annually, which means that interest is going to be compounded twice a year. Well, if it's done twice a year for 5 years, that's 10 times. 5 times 2 is 10 periods. If it's done twice a year, instead of 16%, it's going to be half of that, because you're going to be doing 8% twice a year to be 16%. So you take the 16% and divide by 2. So this time you're going to look down the present value of a single sum for 10 periods at 8%, and you're going to get 0.4632. You multiply that by $100,000 and you get $46,320. In Part B, they make it even more interesting, asking you to assume that interest is compounded quarterly. In this case, you're going to have 4 times a year that you're going to be compounding. So since it's a 5-year life, 4 times a year, that would be 20 periods. 4 times 5 is 20. But since you're doing it 4 times, you would only do 1/4 of the interest rate, so 16% divided by 4 would be 4%. So now you go to the present value of a single sum, and this time you look up 20 periods at 4%, and you find out it's $45,640. In Part C, they ask you to assume a discount rate of 12% is used. All the other factors are staying the same, so you're using your $100,000 for 5 years, but you're using 12% instead. So you're taking the present value of a single sum for 5 periods at 12%. You're going to get a factor of 0.5674. You multiply that by your $100,000, and that gives you $56,740. Then in D, they ask you to do the same thing, only using 20% this time. So everything stays the same number of periods, same amount, except you're looking under the 20% column of that table, and you're going to get a factor of 0.4019. You multiply that by your $100,000, you get $40,190. In E, They're asking you to assume everything is the same, but what you're going to change now is the number of years. You're going to use 3 periods and the same other factors. So you're going to take your $100,000 present value of a single sum, 3 periods at 16%. That factor would be 0.6407. You multiply that by $100,000, you get $64,070. Then in letter F, if you're going to receive the cash in 7 years, that changes the number of periods that you're going to use. So you just read further down the columns till you get to the 7 period line. Read across at 16%, you get 0.3538. Multiply that by your $100,000, you get $35,380. Now what you'll notice is that the further you go into the future, the less the present value is. So looking at that slide up there, you can see that if you did 3 years, it was worth $64,000. Using the same interest rate, if you wait 7 years, it's only worth $35,380. So the further you go into the future, the less it's going to be worth. Let's do one more for practice. Let's look at problem 25 in your textbook. Problem 25 is about halfway down page 224. And this is how you use present value when you're doing lease calculations. It says renter company acquired the use of a machine by agreeing to pay the manufacturer of the machine $900 a year for 10 years. At the time the lease was signed, the interest rate for the 10-year loan was 12%. A, use the appropriate factor from table 6.5 to calculate the amount that they would have paid at the beginning of the lease to buy the machine outright. You're simply going to take your $900 payment. It's an equal payment, so that makes it an annuity. So you will look up the annuity at 12% for 10 periods, and you get 5.6502. Multiplying that by $900, you get $5,085. So the next question they ask you, okay, what's the difference between this $5,085 you calculated and the $9,000 they're actually going to pay? If they're paying $900 a year for 10 years, that's $9,000. The difference between the $5,085 for the equipment and the $9,000 they're going to end up paying is the interest they're going to pay on that debt that they're incurring. And in part C it says, what's the appropriate amount of cost to be recorded on their balance sheet at the time the lease is signed? Well, the cost that you're actually going to have is the $5,085, because remember the difference between the $9,000 they're paying and the $585 that their equipment is worth is all interest. So you don't want the interest recorded on your books ahead of time. So what you do is you record the actual equipment at $5,085. So those are some good examples of how you use present value and future value in real life in the accounting world. This comes to play when we talk about bonds, when we talk about leases. You will see us using these present value calculations again. So keep them in mind as we go through the next couple of chapters.